Imagine if rates went up by 2%, on that $500,000 loan, you'd be paying an extra $615 per month. But on the flip side, if the cash rate were to drop, your interest rate was to fall from 5% to 4.75%, your monthly repayment would decrease similarly. The impact per 0.25% change is roughly $15 per month every $100,000. But how quickly does the change happen? Typically pretty fast. The Reserve Bank announces a cash rate change, usually on a Tuesday afternoon, and within days, well recently it was within hours, the banks issue press releases on how they're adjusting their home loan rates. They usually say it's effective within the next fortnight or so, and then you'll see a change in your mortgage rate within a couple of weeks of that happening. Your bank will notify you either on your internet banking or by a letter with the new interest rate and when the new repayment is going to be reflected. It's important to note that the immediate effect applies to variable rate mortgages only. If you have a fixed rate mortgage, the interest rate on your loan won't change during the fixed rate period. Doesn't matter what the RBA does, you're locked in. So if you fix it, say 2 to 3% 3 years back in 2021, you're pretty much shielded until your fixed rate expires. Once the fixed rate ends, the loan usually switches back to the current variable rate, which will reflected all the cash changes that have happened since you've been fixed. So fixed rate borrowers eventually feel the impact too, just with a bit of a delay. Beyond just your monthly repayment amount, changing interest rates can also affect how much you can borrow in the first place. When rates rise, banks have to assume higher future repayments when they're assessing your loan application, which reduces your borrowing capacity. In fact, analysts have estimated that about a 0.5% increase in rates can shrink the average person's maximum borrowing capacity by about 5%. Put it another way, if you could borrow $500,000 before, on a 0.5% or 0.5% rate hike, you'd only be able to borrow $475,000. Over the Reserve Bank's recent series of increases, which total 4.25% from 2022 to 2023, the average Australian borrowing capacity fell by 40%, which is nuts.